Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest edition of InvesTips from the CIO's desk. I'm Steve Brice and your host for the podcast. Today I want to talk about risk and how you might think about it. If there's one thing you really need to understand, it is your attitude to risk. There are two problems with this. First, the finance industry is not great at quantifying risk in a way that is helpful to the average investor. It leans on measures such as volatility or standard deviation, which incorporates both upside volatility, which of course investors love, and downside volatility, which is feared. Meanwhile, what does a different standard deviation actually mean in terms of what you should expect? I like to think of risk in terms of three things. First, how much money I could lose, which is also known as the maximum drawdown. Second, how quickly the portfolio is likely to recover these losses and make new highs again. And third, with what degree of confidence can I forecast these things? For instance, a diversified balanced portfolio at some point in your lifetime is likely to lose around a third of its value, as it did in the global financial crisis, and then take 3 to 5 years to recoup the losses, or sometimes quicker, as happened in the COVID experience. The good news is that based on history, you can have a reasonably high degree of confidence around predicting these recoveries. However, if you own a much narrower investment, whether it be a stock or a sector, then not only can the drawdown be much more severe, but your confidence in it making new highs again quickly is much lesser. For instance, if you invested in the materials sector, it fell almost 70% in 2008 during the global financial crisis, and even accounting for when you add dividends back to total returns, it only hit sustainably new highs in 2020, 12 years later. As I always say, if a balanced portfolio falls 20%, you should invest more. But if a stock falls 20%, it's difficult to know what the right thing to do is. If quantifying risk is the first challenge, the second issue is understanding your personal attitude to risk. Now, financial advisors usually try to measure your theoretical risk preference via a questionnaire. However, this preference can be very different to your risk propensity in the real world, which is revealed by what you're actually investing in at any given time. But probably the most important variable to understand is how volatile your perception of risk is based on what's going on in the world. You've probably heard Warren Buffett's advice of being greedy when markets are fearful and fearful when markets are greedy. However, most investors find this incredibly difficult to follow through and may believe the risks are lower after a sharp rally in stocks and higher after a sharp decline. We've actually had a recent example of exactly this phenomenon this year, with US stock markets selling off sharply after the so-called US Liberation Day. Based on my interaction with clients and investors, very few took advantage of the sell-off to increase their investments, as the perception of the risks increased sharply after the sell-off, which then fed into them getting scared and, in many cases, partially selling out of their investments. Nobody likes losing money, but all investors will face periods where their portfolios do lose value. How you are invested and how you respond to such losses is critical to your success as an investor. If the sell-off earlier this year scared you, then you're faced with different choices. Assuming you have a diversified portfolio, the wrong thing to do is to sell everything and not invest. An alternative approach is to reframe the issue, reminding yourself about your investment plan and time horizon, and that these losses will be temporary for a balanced portfolio. Hopefully, this strengthens your resolve to stick with the plan. A final approach is to say that volatility that we've just seen is much more than you can stomach, and therefore you look for opportunities to reallocate your investments to reduce the size of potential drawdowns from a percentage perspective. This could be achieved by reducing your allocation to riskier areas of the portfolio, such as stocks, or focusing new investments to other areas of the global stock market, bond market, gold, or deposits. Whatever you do, I suggest you write down your decision-making process during this this situation and review the outcomes at a later point, and remind yourself of this during future bouts of volatility. This maximizes the probability of you learning the lessons permanently rather than repeating them in the future. Well, that's all we have time for today. I hope you found this discussion of risk useful. If you can manage your emotions, you dramatically improve your chances of financial success. Until next time, take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.